Let's talk about the data first. It's the data and the reaction function. Data, the unemployment rate is unchanged from a year ago. Core PCE inflation is about 60 basis points above where it was a year ago, and only some of that is one-off. So despite all this, policy is 75 basis points easier than last year. To us, they're clearly offside. So our forecast is just that they'll take back the cuts that they did last year. They were risk management cuts. Those risks around labor have dissipated at this point. And then in terms of the reaction function, we thought going into June that this was fundamentally a dovish FOMC that would find reasons to not hike rates. But the SEP, it's not just about the dot plot. It's the fact that 9 people expect to hike, even though no one has the unemployment rate falling this year. So that for us is a hawkish shift in the reaction function.
I couldn't believe the guy from South Africa was offside by a toe length.
Saw that.
That was just absolutely ridiculous.
But you don't need replay for this one.
But you don't need a VAR. Kevin Warsh doesn't get a VAR. What he does get is a nonlinear function.
Yes.
One rate rise, a second, a third, wildly nonlinear, correct?
I don't think it's wildly nonlinear. 75 basis points is very normal for a mini cycle for the Fed. So to be clear, we don't think they have as much of an inflation problem as they did back in 2022. Underlying inflation isn't 3.5%. It's probably closer to 2.8 or something like that, which is why they don't need to go back to 5%, right? At 3.5% core PCE, the Taylor rule would tell you need to be at 5%. That's not what we're calling for.
So how's the consumer doing out there? I mean, better than we think? How's the consumer doing?
The consumer is doing great. And we actually have data to back this up. So the Bank of America data, credit and debit card spending, we report this almost in real time. We've already published reports through the 20th of June. And what we're seeing is an acceleration in spending X of gas as gas prices come down, even though you didn't really see a deceleration X of gas as gas prices went up. So the consumer is in good shape. Now, some of this could be a boost from the World Cup that rolls off, but there's no clear sign again that the risks to activity are to the downside. And just going back to Robert Frost for a second, Tom, he has promises to keep. Warsh has promises to keep.
So, but
that was a Colby Smith article today.
Well, I still have Amherst. They're still the Lord Jeffs to me. I'm not going to them whole mammoth thing.
No comment. No comment.
Talk to us about, so presumably the Fed and this chairman has some political pressure to lower rates. Boy, if he tries to do three rate hikes this year, the social media posts are going to be fast and furious. Does that figure into your calculus at all?
That's a bit outside my wheelhouse, but what I would say, just as a statement of fact, is that the president noted during the press conference that he would be okay with the Fed hiking rates. And honestly, if you think about Chair Warsh's incentives right now, he has a brief window where he can hike rates and not necessarily take the blame in the sense that the inflation happened under the previous regime. If he doesn't hike now and inflation doesn't get better over the next year and there's a lot of pressure from the committee to hike next year, he'll have to own that.
Longer term, in terms of inflation, to the extent that this decline of globalization, I'm not sure if you guys subscribe to that, but this decline of globalization, this America first, the nearshoring, friendshoring, doesn't that structurally lift inflation?
It does. It does. And we're seeing some of that in the inflation data as well. If you look at the underlying drivers of inflation, for sure, we don't have a disastrous problem around demand, again, which is why policy doesn't need to go to 5-6%. But supply drivers are really, really sticky. And that's not going away, right? It's just wave after wave of supply shock. And that's something the Fed will have to contend with. If you're looking at 5-10 years of supply-driven inflation just being elevated, then you have to put more downward pressure on demand, or you have to accept that you're always going to miss your target by 50-70 basis points.
When you talk to your equity people, who are really competent, like a huge Excel spreadsheet, quantitative strength, if you get above A3 rate increases, what does the stock market do?
My sense is it'll be fine. I mean, look at the fact that we've gone from 2 cuts priced for this year to a hike and a half, and equities have navigated that just fine. So another hike and a half, could that be the straw that breaks the camel's back? Maybe, but I don't think that's a slam dunk either.
So for labor, what is the B of A kind of AI call as it relates to the labor market? Kind of intermediate to longest term, I guess.
Right. So the longer term view is that AI will replace tasks more than it will replace jobs. So ultimately, there's going to be creation of a whole bunch of new jobs that we just can't conceive of right now. So I like the statistic. Something like 60% of jobs that exist today did not exist back in 1940. Right? So I think there's going to be something like that happening down the line. Now, that said, there is a transition period. There are going to be winners and losers. And the speed of that transition is going to matter a lot in the near term for Fed policy.